Well, good afternoon. It is time for today's market update. It is Thursday, the 13th of March. I hope you are doing well. Well, we've seen interest rates after a nice start to the month, y'all. We've seen them over the last 7 trading sessions trending higher. Here's where we are today. I'm going to dive right into the Mortgage News Daily survey for today. 6.82 is the national average for a 30-year conforming fixed rate loan. 1 week ago, we were at 6.79, so we're just trending slightly higher. 30 days ago, we were at 7.04, so we're still about a quarter of a point better than we were at 30 days ago. So we've seen nice improvement in the last month, but we've given a good chunk of that back, almost half of that back now, over the last 2 weeks as trade policy has really dominated the headlines, y'all. It's put jitters into the stock market. You've seen a lot of volatility there. But what's moved the market this week and what should have moved interest rates further down is inflation. We got very favorable reads on inflation from both the CPI, which came out yesterday. It was up 0.2%. It was expected to be up 0.3. So we got a tenth better report than we expected. Year over year, inflation is 2.8% in the CPA survey. That is down from 3% in the prior read. And it was expected to come in at 2.9, so a tenth better on the overall year-over-year number. So that should have helped interest rates significantly. It really didn't. Y'all, the producer price index came out today, also quite a bit better than expected. Headline number came in flat 0.0 change from the prior month. It was expected to be up 0.3, y'all. So that was a huge miss in the right direction. Year-over-year number came in at 3.2 from 3.7. It was expected to come in at 3.3. So again, a tenth better than expectations on the PPI, which has more weight on the wholesale side. So very good reads on inflation, really everything the bond market could have expected. And yet we're not seeing the benefit of that you would hope to see, in part due to the jitters that you are seeing in equities. You have a lot of folks that are stepping in. They're seeing some value opportunity to buy specific stocks on their dip. And I think you're seeing a lot of that even as the overall numbers and trend lines in equities have been down, and down significantly, y'all. The Dow is down 600 points today. It's down 4,000 points in the last 30 days, y'all. That's nearly 10% correction in the Dow off of its 12-month high. So that is a really strong move in equities, y'all. And I do think that a lot of the money that would otherwise be going into the bond market is being pulled into cash while folks try and sort out whether the improvements that we're seeing in inflation are real in light of the fear over tariffs increasing prices over time. And this is where this call is going to get a little bit political, y'all. I think it needs to be pointed out. I've not seen this pointed out. I'm not following any pundits here with this opinion. But we have a country that is essentially a 51-49 country according to the last election, right? The current administration won with a 51-49 mandate in the popular vote. And what that means, y'all, if you look at the approval ratings of where it stands right now, the average of all polls on Real Clear Politics as far as presidential approval has the current administration dead even at 49 and change. So this country is still completely divided in half with regard to whether they support this administration or not. And keep in mind, a lot of those folks invest. It's not an extrapolation to say that half the folks that are in the stock market buying stocks right now didn't support the current administration, and they're not likely to be very generous in their interpretation of his trade policy and what it means for the future. Those folks, understandably, are likely to be more pessimistic in their view of the direction of this administration when they see the disruption and the challenges to the norms that we have seen for generations that this administration is posing. The flip side is also true. If you supported this president, then you're likely familiar with his book, The Art of the Deal. You're likely familiar with how he negotiates deals, and you start by making your threats real. And there's nothing that makes tariffs more impactful than not threatening with them, but just to simply impose them and then negotiate a better deal and pull them back. So if you're supportive of this administration, then you likely see that as the future outcome, that we're going to wind up with much better trade deals. What it means is a lot of back and forth in trading, y'all, a lot of confusion in the marketplace as those two competing views on where we are headed try to find their own level. And you're seeing that played out in interest rates. It makes it tough to predict where we're headed, bluntly. But But let's talk about what the market has been facing as far as jitters are concerned over the last several weeks, and that is the fear of recession. The fear that all of these layoffs will lead to spikes in unemployment, that will hurt consumer confidence, that will lead to less buying, and we slip into negative growth. That would certainly be bolstered by negative GDP growth in the last quarter. When you put all of that together, y'all, if we were to lead into a recession, let's look at the positive side of that. Nothing ends an inflationary cycle faster than a recession. That will put inflation to bed if we do, in fact, enter a recession. It also will make for a very aggressive Federal Reserve as far as liquidity is concerned, at the top of the house as far as pricing of fixed income securities is concerned. We're going to see the Fed far more friendly to rate cuts in a recessionary environment. So recessions are historically very good for housing. Y'all, so if we do happen to have one, if your focus in watching this video, and it's likely the case that you want to see improvements in the housing market, well, recessions are good for housing, y'all. They just always have been. You look back in history, you can see that demonstrated very strongly. We've never had a stronger housing market than we had in 2020 in the recession that we were in due to the COVID situation and the shutdown. So again, where we are headed in the future, it has a lot of uncertainty in it. There's a lot of politics in it. We're just going to have to wait and see. Track these changes as they come. Right now, I frankly think that the downside for interest rates looks pretty good, y'all. I think that we may end this year in a far more favorable place rate-wise than we were otherwise expecting. So more to follow on that. Every bit of news changes this equation, y'all. All eyes will be fixed on the labor markets as our next big domino to fall, first Friday of every month, and we'll keep an eye on that. In any event, I hope this information is helpful for you and for your clients. As always, if you have any questions, we're always honored to have those questions. Love to have those conversations offline. Feel free to give me a shout and we can talk politics if you want to. But y'all, our bread and butter here is doing mortgages and doing them extremely well. We've got 30 years experience under our belts here at BryceHomeLoans.com. Would be honored to have your referrals. Let's work together. Let's have some fun, and we will talk to you next week.